The biggest gains you'll ever miss will cost you nothing. The ones you chase will cost you everything. What did you chase last week? Right now, as I'm recording this, ILLR is up 314% in a single day. Micron just closed up 14%. And somewhere, an investor who's been building wealth methodically for 3 years is about to destroy 6 months of progress in the next 48 hours. Not because of a crash, because of comparison. Seneca wrote something 20 centuries ago that every modern investor needs tattooed on their trading hand. It is not the man who has too little, but the man who craves more that is poor. He wasn't talking about contentment. He was diagnosing the most expensive psychological trap in markets. The pain of missing an opportunity, the agony of relative deprivation. It's not just unpleasant. Research shows it's neurologically more intense than losing the same amount of actual money. You can lose $10,000 in a correction and sleep that night. But watch your colleague make $10,000 on a stock you almost bought? That eats you alive for weeks. This is why FOMO trading, fear of missing out, executed as action, destroys more wealth than any crash. Crashes are external. They happen to everyone. They're strangely democratic. But FOMO, that's personal. That's you watching other people get rich while you stand still. And that feeling, that specific psychological pain, makes you abandon every principle you know. Here's what's actually happening in your brain. When you see extreme single-day gains, your anterior insula lights up. That's the same region that processes physical disgust and social rejection. Missing an opportunity doesn't feel like a neutral event. It feels like being excluded, like being left behind. And your brain will do almost anything to make that feeling stop. So you act. You chase. You tell yourself it's still early. You abandon your strategy mid-execution to grab what everyone else is grabbing. And Seneca, standing in the ruins of Rome, already knew how this story ends. The problem isn't that opportunities exist. The problem is that you think missing one makes you poorer. Let me show you what this looks like in real time. Marcus Sterling got the notification at 9:47 a.m. His phone lit up with the alert. Small cap biotech, ticker symbol ILLR, up 160% in the first hour of trading. FDA approval rumor. Volume exploding. Every trading chat room screaming the same thing. Get in now. He glanced at it, set the phone face down, went back to his coffee. Across town, Alex Chen got the same alert. But Alex didn't just glance. Alex opened the app, checked the chart, saw that vertical line climbing, then made his first mistake. He checked his own portfolio. His positions were green, modest gains, disciplined entries from weeks ago. Solid companies. Good fundamentals. Up 2%, 3%, 5%. And suddenly, they felt pathetic. Not because they were losing, because they weren't winning enough. Not compared to this. Not compared to 300%. Alex opened a new tab, started reading. The company had been developing a treatment. The trial data was promising but not yet peer-reviewed. The volume was unusual. The price was already up 200% from yesterday's close. Every rational signal said wait. Every emotional signal screamed move. He felt it rising in his chest. That specific heat. Not quite panic. Not quite greed. Something worse. The feeling of being on the outside. Of watching the train leave without him. Of being the only person at the wait party who didn't get the joke. His thumb hovered over the buy button. Meanwhile, Marcus Sterling opened his journal. This is what he wrote. ILLR up 314%. Everyone buying. I feel nothing about the stock. I feel something about not being in the stock. Seneca's question, am I poorer because this exists? No. Am I poorer because others bought it? No. Will I be richer if I abandon my strategy to chase it? No. Then he wrote one more line. The line that saved him thousands. The wealth I build is not measured against what strangers made today. Alex didn't write anything. Alex bought $4,000 worth at $3.18. Not because he understood the company, because he understood he couldn't stand watching anymore. By noon, ILLR was at $4. Alex felt vindicated. See? Still early. Still time. By close, it was back at $2.80. Alex held. It's just consolidation. It'll run again. 3 days later, it was at $1.60. News broke that the FDA approval rumor was based on a misread preliminary filing. The company released a statement. No approval. No timeline. The volume that drove it up evaporated. The price collapsed. Alex sold at $1.40. Lost almost 65% in 72 hours. But here's what actually cost him. Not the $4,000 he put in. Not even the $2,600 he lost. It was what happened next. He looked at his original positions, the ones that felt pathetic at 2 and 3 and 5%. They'd continued climbing, steady, unglamorous, exactly as planned. If he'd done nothing, if he'd simply let his strategy work, he'd have been up 8% across his portfolio. Instead, he was down 4%. Not because the market crashed, because he couldn't stand feeling left out. Marcus Sterling's portfolio? Also up 8%. Same time frame, same market, different investor. Here's what Marcus understood that Alex is still learning. The Stoic investor doesn't avoid opportunities. He avoids the delusion that missing an opportunity is the same as losing money. You cannot lose what you never had. You are not poorer because someone else got richer. And the moment you start measuring your wealth against the best single-day gain you saw someone else make, you have already lost. Seneca again. If you wish to make Pythocles rich, do not add to his store of money, but subtract from his desires. The same is true for you. So here's your one action. Next time you see an extreme mover, a stock up 50%, 100%, 300% in a day, and you feel that heat rising, that voice saying you're missing it, do this. Open your notes app. Write one sentence. I am not poorer because this exists. Then close the app. Walk away. Go back to your strategy. That's it. One sentence. One choice. One moment where you choose wealth over feeling wealthy compared to strangers. Do that enough times, and you'll discover something Seneca knew 2,000 years ago. The investor who stops measuring himself against the market's wildest days ends up wealthier than the one who chases all of them. Knowing the principle isn't enough. The next video shows exactly how to apply it.